So yeah, so today's lecture or whatnot, objective is to give you guys a bit of a primer on thinking about financial modeling, to some extent valuation. It'll be more kind of the financial modeling aspect of things for a particular type of business, which is recurring revenue businesses. I'm not going to go through this stuff with a fine-tooth comb because we only have an hour. I'll do kind of more overview style. So, you know, it may be that your head spins a little bit as I talk through some of these things because I just don't have the time to kind of go, you know, okay, you know, cell by cell, this is what's happening. But I will send out links to videos that are on YouTube where I do go over this stuff with a fine-tooth comb. And if this interests you and you have time, you can watch the videos at a later time, maybe after your midterms, after your finals. You know, I don't know, like maybe, you know, Christmas Eve before Santa comes to town, you know, you've got the cookies there, you can watch the little YouTube thing. But in any case, there will be videos that kind of go through it in more detail. That's pretty easy because I've already posted them online. But the objective here is really more like high level overview and maybe get you guys a little bit of buy-in on the idea that actually investing time and effort into learning the idiosyncrasies of these types of companies is a worthwhile investment, even though you probably aren't actually being asked to do this in any of your courses. I think this is definitely one of these things where the way the world is trending, by the way, the world is already there. Like basically classes are lagging behind on this. Okay, but in any case, let's go ahead and let me share my screen and start discussing this. Can folks see my slides? Someone can feel free.
Yeah, you're good.
All right, so we're good. All right, so, can you guys see the little hand moving around?
Yep.
Okay, so, yeah, okay, this is the title, okay? Recurring revenue businesses, that's what we're gonna be analyzing. You can view it as a case study in bottom-up forecasting and valuation. But, you know, yes, it's a useful case study of that, but it's far more important than that because, you know, I think kind of recurring revenue businesses are just going to be a growing subset of aggregate market cap. Probably most companies that you can think of right now, the ones that are particularly valuable, you can really think of them as recurring revenue businesses. Let me actually kind of give you guys a bit of background on this. So, you know, look, this is a bit of motivation, and I want to show you guys some data on two companies. These are two companies in the periods before they go public. So think of period 3 being the year before a company goes public, and then we're going back kind of, you know, 3 years before the IPO date. And we've got two companies, two software companies here. And what I've plotted here is the revenues of the company. I think we can agree. It's not identical, but it looks rather similar, right? So two software companies. They look similar here, but let me show you how they look different. Specifically, they look different when you look at the pattern of operating income for these companies. The first company, you know, look, both of them have revenues that are growing pretty rapidly in the years before their IPO. The first company kind of looks pretty normal, right? It kind of is like what we expect to see usually, which is your revenues are growing fast, and, you know, oftentimes, at least certainly we hope that your margins are positive. And so as a result, your profits are growing as well, right? So company one, kind of like a by the book, traditional corporate finance kind of thing, right? Probably most of the examples that you get given in the classroom, you know, this is what they would look like. Stark contrast to the second company. Second company, even though it's got, you know, similar revenues, similar growth of revenues, the operating income looks like a different story, right? They're losing money. So margins, the way we typically measure them, aren't looking pretty, right? You got negative margins, and I'm not sure if the margins are getting more and more negative, but the losses are getting more and more negative, right? Look, if you see a company like this, I'm just kind of curious, right? Are you a little bit worried with this company? Maybe put a little thumbs up if you know, at first glance, without knowing anything about the company, you're like, ooh, all right, so one, I'm glad one person has an opinion. Two, I guess I can't really tell if, anyway, I mean, I guess I'm not going to be able to do the stats on this. Sophie, very nice creativity. Right, a lot of people look at this and are like, oh, you know, like, should we, is this company IPO ready, right? By the way, that is a question I asked myself. When I was asked to develop the VC course, look, a very natural thing to start looking at is startups and startups that have their exit, you know, in particular an IPO exit. I went and looked at data on those companies and I saw a pattern like this. And I was like, my God, how is this possible? The reason why I asked myself, why is this possible, is because I was thinking about companies in a very traditional sense where I'm like, look, you know, things are going well. Yes, your revenue is growing, but I expect you to be earning profits and I expect those profits to be growing too. And this was like, well, very much different when we take a look at the operating income pattern, right? It's like, it's literally flipped, right? And so I can think of a narrative where like, this company sucks, right? And I wanted to figure out like, well, does it? Is the market that stupid? By the way, I like to say the market is stupid, but I actually don't think the market is stupid. The market is pretty smart. So when I saw this, my gut is telling me this is a terrible company. But you know, the fact that the market is cool with it told me that I probably should dig into this a little bit more and think about this more carefully. Okay. So now let me tell you what these two companies are. The first company is one company. It's Microsoft in the 3 years before it goes public. The second company is not actually one company. It's an average of a sample of companies, namely the sample of SaaS IPOs in the years before they go public, looking at all companies in a particular SaaS index, the Bessemer Venture Partners Cloud Index, and looking at all the IPOs that occurred for members of that index between 2012 and 2019. So this is like the average of companies going public that are SaaS in recent times, right? The reason why I picked this is like the revenue trajectory looked so similar to Microsoft, and the obviously, as we see, the operating income trajectory was very different. So look, this first tells you something, I think, that is important, which is if we, by the way, SaaS, software as a service, that is probably one of the leading examples of companies that are recurring revenue based, right? Recurring revenue, what we really mean is if you look at the customer level, right? You acquire a customer today, like most businesses, you probably had to pay money to get that customer, sales, marketing, other stuff, right? You pay money to get someone up front, right? But that customer is going to predictably continue giving you goodies beyond that first period. You do not need to remarket to that customer over and over and over and over, right? Traditional software, there was a big element of remarket to customers because, you know, you bought a software CD, right? You bought it, you own it forever. And then, you know, the software company hopes to get money from you again when they come up with the next version of their software, but they need to actually market to you again to get you to buy their CD, right? And so, you know, customer acquisition with traditional software businesses like Microsoft back in the day, or every software company back in the day, was, you know, to a certain extent of this variety where you pay money to get the customer now. You better be making all that money back now, because when you want them to get V2 of your software in the future, you'll have to pay to get them again. And so it's kind of like one-shot customer transactions. I mean, look, it's not quite as black and white as I'm saying right now, and it was pretty white versus pretty black, let's be clear. meanwhile, it's quite different with software as a service, right? I mean, I don't know if you guys actually pay for consumer SaaS products, right? Dropbox or something like that. But at least if you're anything like me, you pay for it and you're not revisiting period by period whether you're going to keep on using it. It's pretty much an automatic. Maybe that. Well, I think the data speaks pretty loudly that that's the case, right? Churn rates on the good SaaS products are actually quite low for now, right? And look, this seems to say that like good SaaS companies exhibit a strikingly different pattern of operating income. More generally, we could think of cash flows, yada yada, than their traditional counterparts. And by the way, like if you think about, let's quote the one of the greatest Canadians of all time, Wayne Gretzky, right? Wayne Gretzky, kind of a smart guy when it comes to hockey, and one of the things that he talked about when he talked about his philosophy of playing hockey is he said, "I skate to where the puck is going, not to where the puck is." Right? Well, where is the puck going in the world of software? It's going to recurring revenue. It's going to a software as a service model. I mean, we see this, right? Because think of all the large traditional software players, Adobe, Microsoft, et cetera, et cetera. I mean, they've all moved to SaaS, right? When's the last time you bought a software CD? We don't even have CD drives in our, we don't even like download the something. Right? I think we all get the point. That's where the puck is going for software. Look, to just kind of highlight this, what I have here is data from the Bessemer Venture Partners. Bessemer Venture Partners is a very prominent venture firm, mainly based out of the Bay Area, also Boston to some extent. Within the Canadian startup ecosystem, they're well known as being the first venture investor into Shopify, for instance. They're also kind of well known in recent times for having kind of built one of the most notable indices for SaaS or for cloud. It's called the Bessemer Venture Partners NASDAQ Emerging Cloud Index. That is the dark orange thing that we see here. That's performed better than everything else, right? Than the NASDAQ index, than the S&P 500, right? Not by a small amount. It's kind of kicked ass. Look, this tells us that these types of companies are of growing prominence in the market. As of August 7, 2020, they represented over 1.5 trillion in market cap. That number is higher now, right? Where is the puck going, right? It's kind of going towards recurring revenue businesses. So we might want to think about that, especially in light of the fact of this strikingly different pattern. Because what this pattern tells me is that if I use the insights or the intuitions of traditional business model and teleport them to recurring revenue businesses, I may kind of be missing the point and missing the mark, right? And so I want to figure it out. I want to understand, how should I analyze these companies, and in what ways is it different from these companies? Strikes me as a first order question. Let me show you guys some examples. Uber and Lyft, right? Recurring revenue businesses. Years before IPO, revenue, starting at the point 3 years before the IPO. This is what happened with Lyft. This is what happened with Uber. This is the losses. As we can see, it's not like they're turning profitable right away. Wayfair, ba-boom, ba-boom. Spotify, ba-boom, ba-boom. Twitter, that was, I couldn't go that high. Good for Twitter. That, by the way, their pattern looks a little bit different in terms of like more dramatically lowering their losses in the last year. That has a lot to do with the fact that Twitter had more viral customer acquisition than everyone else. When we look at the modeling, if you look at it carefully, I'm probably not going to be able to do that quite as well in the lecture today. What you see is it actually makes sense that this happened with Twitter precisely because they have low customer acquisition costs. But that's Twitter. We, Okay, whatever, you know, it's recurring revenue, maybe a little bit more of a clusterfuck than everyone else. But, and by the way, they didn't actually go public here. I think we all know about that. Yeah, they kind of look like, let's see, we take the average of all this stuff and this is what we get, right? So, you know, my point is this pattern, barum, barum, we get it when we kind of put the usual suspects together. By the way, similar pattern post IPO, right? Years after the IPO this is revenue. This is looking at SaaS, right? SaaS continues to have growing losses on average in the 3 years after the IPO, or 4 actually. And then other recurring revenue. So that throws in companies like Amazon into the mix. You see the same thing, right? Interesting to me. Hopefully interesting to you. Oh, you know what? This number here was not revenue. This number was post-IPO profit, but for traditional software companies. Apologies for the misquote. So look, on this slide, by the way, I will share the materials with you. So no need to frantically write anything. I'm just defining traditional business model versus recurring revenue business model. But I've already done it, so I don't think there's a need to reread this. Hopefully we're okay with that. Look, I want to give you guys first a basic understanding for why we see the patterns that I just described for recurring revenue businesses. And in particular, let me further emphasize that what I'm about to say applies for a very special subset of recurring revenue businesses. It is recurring revenue businesses that are high growth and that have material customer acquisition costs. Okay. So, you know, if you're Facebook and you're able to get viral customer acquisition so that your cost of getting a customer is approximately 0, what I'm about to say does not apply. And indeed, consistent with that, Facebook was profitable in the years before they went public, the years after, and they had basically growing profits. Okay. So this is not a story about, oh, I'm sorry, the company formerly known as Facebook, now known as Meta. In it. Okay. Thank you, Zach. What was I saying now? Okay. Let me kind of give the intuition here. Let me just pick one of these. I'll go back to this guy. So the question is like, what drives these losses, right? The intuition is actually pretty simple. Because if we look at the profits that a recurring revenue business generates in the period where they generate this revenue, I think of it as a tug of war between two things, okay? There is the revenue that you generate from the users you got this period, right? You know, one simple way to think about it is that's gonna come from the customers that you got in the past. Let's say that the customers you get right now aren't going to pay until the end of the period, just whatever. I mean, that's just to fix ideas, right? That means your revenue this period is actually the revenue you get from all the customers you acquired in the past until this period. So that's the positive tug on your profits. It's a good thing. It's a good thing. It's like a cherry, right? And then you got a negative tug. The negative tug is the customer acquisition cost that you need to pay to get the new users that you got this period. Everyone on board with that simple tug of war? Maybe thumbs up it or something so I can know. I'm not going to put much weight on the thumbs up from Ben because Ben has probably thought about this because of his work at Constellation. Is this correct, Ben?
Yes, that is correct.
Yeah, so I'm not really lecturing to you today. And the fact that you're the only thumbs up does worry me a bit, but you know what? What can I do about it? In any case, look, so that you've got that tug of war. Now let's think about like which side wins the tug of war? The more customers you acquire today, the bigger the negative tug on customer acquisition cost. You're just spending a shitload of money to get those customers. It's not necessarily a bad thing, right? But today, it maybe looks bad if you think of it very myopically, because you're spending a lot, right? Look, that requires the CAC to be materially large. Most SaaS companies have non-negligible CAC. Very few get the joy of viral customer acquisition, right? So, so let's think about when the negative tug beats the positive tug, right? The positive tug was the cherry. It's the marginal profits you get from your past customers. The negative tug, what's the opposite of a cherry? A Brussels sprout. I love and hate Brussels sprouts. Brussels sprout, pushing it down. How big is the Brussels sprout? The Brussels sprout is bigger the more customers you acquire right now, and is bigger the larger the CAC per customer is. In other words, if you are growing fast enough and you've got large enough customer acquisition costs, do we agree? The Brussels sprout may be bigger than the cherry. I'll assume that everyone is okay with that statement. It would be nice if you guys could thumbs up things so I just kind of know what's happening in your brains. But in any case, yeah, that can happen, right? So that's basically the logic of this pattern. For a high growth, large enough CAC business, the Brussels sprout is bigger than the cherry, and you get this pattern. Is this pattern necessarily bad? Ben, you want to answer that question?
Sorry, I didn't hear what you said there, Jiro.
It's okay, it happens.
Sorry.
I said, can you tell me a circumstance when this pattern, the weird pattern that we highlighted for SaaS, like under what conditions would this actually be good news as opposed to bad news? Because to most people, they look at this and they think it's bad news. And what I want to highlight is when we think about it as a tug of war between cherry and Brussels sprout, we start to see that this may not be bad news. In fact, rather the opposite. It could actually be very, very good news. The question is, what does this hinge on?
I can hop in if you want.
Yeah, so I don't know who's talking, but yeah, go ahead.
It's the other Ben. I thought you were calling on me. I was just gonna say like how sticky the customers are, like if they can easily switch to another vendor or whatever you want to call them.
Yeah, so Ben is picking up on something that is part of the answer, which, right? And Ben, the stickier the customer, the more likely this is what? Good news or bad news?
Great news. If they can't switch, like if you look at Microsoft, like if your whole corporation picks up Microsoft, they're probably not going to switch in the next like 5-10 years, really.
Yeah, that's right. So, right, the stickier the customer is, i.e. the more recurring they are, the better. I mean, this is not meant to be like Einstein level nuance, right? It's just literally saying like the longer they, like those Brussels sprouts right now will give you cherries in the future. That's really what I'm saying, right?
Yeah, I think to answer the other half was the like I don't know. I know you're using the cherry Brussels sprout terminology, but like if your cost of acquisition is materially less than the proceeds you're going to receive from that customer in the next like near-term future, then it's obviously a lot better too. Like if you're pretty much paying, like if you look at Good Food or HelloFresh, like those people are pretty much paying as much money as they're going to be making in the near future from their customers. But some of these SaaS companies can pay a lot less than they're going to be making from them to acquire them.
Yeah, I'm also realizing I kind of screwed up with my example because I shouldn't have called it a cherry. I should have called it gravy, but that's my bad. Look, Ben is picking up on all the themes, but let me actually give you guys the lingo around, because no one in the world calls it gravy or cherry and Brussels sprout. So let me give you the actual lingo. The lingo is unit economics, okay? Now, what does unit economics mean? One way to think about it, the perfect way to think about it, is to think about individual customer acquisition as an NPV problem, right? How much do you pay to get on average one paid customer? And once you have a paid customer, what is the stream of net benefits that that customer provides you in expectation going forward in the future? Well, now we've just established a stream of expected cash flows. Why don't we do NPV on those cash flows and figure out whether that number is very positive, marginally positive, or negative, right? The NPV of this exercise, let's be clear, it's the NPV at the customer level, right? If that NPV is positive, we say that there is positive unit economics to customer acquisition. And if that unit economics is positive, this pattern is good news. If unit economics is negative, this pattern is shit news. So it's very interesting because there's a knife edge, right? This flips from being great news to being terrible news entirely on the basis of NPV of customer acquisition. And let's be clear, NPV of customer acquisition is not the same thing as NPV of the firm. By the way, side note, it turns out early on for a company, it is easier, some caveats to this statement, by the way, but it is easier to assess unit economics than it is to value the company as a whole. By the way, this is something that I talk about in my VC and financing of startups course. And in fact, consistent with this idea, the first set of analytics that VCs, growth stage PE, by the way, we're even seeing this in the early phases of public markets for these types of companies. The first set of quantitative exercises that you do for a startup or for a scale up of this variety is unit economics. It's not NPV of the entire company. The reason is because it's actually a more manageable problem to try to model out at the relatively early stage. Does this make sense to people? I'm realizing that there might be questions. Well, let me just see what was said here. Sorry about that. Sophie Song, attractive unit economics, exactly. Yep, that is correct. Sophie wrote it right. Unit economics, X easily addressable market for valuation. Benjamin, what you're saying is that would be like a rough back of the envelope calculation of the value of the company. Is that correct?
Yeah, that's what I was just wondering because you were bringing it up.
Yeah, that's right. Look, at the end of the day, if a unit economics is the NPV of a customer, right? And let's ignore growth, like when are you going to get your customers kind of thing, and just view it very statically, which is not perfect, but for a back of the envelope calculation, it's okay. It's literally unit economics times number of customers, which I guess is one metric. One metric of that is just your addressable market. Let's be clear. In this case, we're quoting the addressable market on a unit basis and not a dollar basis. But yes, that's a perfectly fine way to kind of wrap your mind on the intuition of things. So I totally agree.
Thank you.
So far, so good. Anyway, look, if you get one thing from today's chit chat, it should be that, right? It should be the intuition that we just talked through. It is by far the most important thing in thinking about, how is recurring revenue, how are recurring revenue businesses different from traditional businesses, and why does it lead to strikingly different operating income, cash flow patterns for the subset of the recurring revenue businesses that are simultaneously high growth and sufficiently material customer acquisition cost based businesses. And if you don't understand that, you're simply not well equipped to analyze these companies. And given their growing importance in our economy, and the fact that that trend is almost surely just going to continue to magnify, like, honestly, how can you not want to know how to do this, right? That's, look, the intuition here is our 80-20 on starting to wrap our minds around this. Are we okay with this so far? Don't be shy. I'm using the thumbs up as a guide for whether I should continue. Yeah, and unfortunately, I can only see 5 people at once because I don't have my dual monitors set up right now. But I saw thumbs up. Actually, maybe I should have just said, problem is no one ever wants to admit that they're lost. That's the problem, right? Anyway, I think that's a checkmate on that one. Okay, now let's talk about starting to model this stuff, right? Because it's one thing to have a broad little like cute intuition on it, which by the way is the main driver of everything you see, but it's an altogether different thing to actually think about how are we going to actually model out the details. And as you guys know, you guys have done this often enough where you've done a DCF for valuation purposes, the details matter, right? And so the question is like, what are best practices around doing that financial modeling for this type of business, right? For a recurring revenue business model, right? So let me highlight this. And there's going to be a few unique elements that become really convenient to allowing us to do this rigorously that we don't really think through for other types of businesses, okay? In a nutshell, just a preview, the real thing that's going to be different about the way we do this versus the way we would have done it with a traditional business model, or like, with a valuation where we're not thinking about the bottom up a recurring revenue element of things, and we're kind of going maybe more kind of top down, right? By the way, like almost everything I've seen from you guys tends to not incorporate this stuff and tends to have, to me, like more of a top-down element to it. And this is not a criticism to that. But for these types of businesses, we can all see how that might be problematic, because how do you top down yourself to like a pattern where you've got growing losses and that's good news? It's kind of, you have to start getting a little creative to do that. And then the question is it the right or the wrong kind of creativity? But let's take a look at this. So we're going to highlight this via example. And okay, let me just close the loop on the most important thing to remember in terms of the way we do our analysis differently in building our model for a recurring revenue business model. And the answer to that question lies on making use of something called a cohort analysis. A cohort analysis means rather than trying to get straight to revenue and straight to net income for our company, what we're going to do is we're going to first break down a lot of the things that are happening at the company level by cohort first. In other words, we'll model out like the cohort we just acquired versus the cohorts we've acquired in the past versus the cohorts we will or we hope to acquire in the future. We will model each of those, cohort strips separately. And we'll see when we take a look at the model why that's actually convenient and really, at least to me, really helpful. My view is if you try to skip steps and not first do your cohort analysis and you try to get straight to the final answer, you're probably going to make a mistake, to be honest. Like, it would be a miracle if you did it. I mean, it would be a miracle if I got it right without doing it. So, maybe you're a finance Einstein, but like most people, I think you do the cohort analysis. So, one thing to kind of get with our discussion right now is really like thinking through, like, do you at least kind of roughly get what I mean by a cohort analysis? Do you appreciate why it makes your life simpler? And then filling out the details again I'll send out 2 YouTube videos that that have me kind of going through it. Just a warning, those videos, if you listen to them at 1x speed, they might be like a total of 6 hours long. So it is what it is. That's why I can't do fine tooth comb here, right? But I want to give you guys enough in 1 hour that it helps accelerate any sort of learning you choose to do on this front. Again, my view, I'm telling you, like, my view is you're making a mistake if you don't deep dive this topic, because that's where by the way, the puck is already here. Like, it was where the puck was going about, 5 to 10 years ago. The puck is here, and the puck is like going to be even more here in 5 years, right? So like, if you guys are better than a lot of people at doing this, it is an edge that you have in your career. Like, that's my opinion, right? And by the way, there is a path where you have an edge over everyone else, precisely because almost no finance courses teach this. Why? That's a good question. But you should view that as an opportunity. Just a side comment, like the non-McGill stuff that I do, some of the stuff that I do is around, valuation work for startups. The thing I hang my hat on in that line of work is precisely that I've spent more time thinking about this than almost anyone else, right? So like, I'm not just telling you this and talking out of my ass. I'm actually, like, what I am telling is one of these few instances in my life where what I'm telling you that I think you should do, I'm actually doing it, right? So, whatever, at least I'm, I'm showing you that I practice what I preach in this case. Plenty of instances where I don't. This is one of the few where I do. So let's take a look at this. So I'm going to do this in a very stylized way, okay? Because I just want to first get us anchored on the basics, all right? And so to get us anchored on the basics, we're going to start with this simple example of a hypothetical representative SaaS company. So in particular, we're going to consider a high-flying private SaaS startup. Let's assume so far the company has acquired 256 customers. So they were acquired in the past. So time -1, time -2, time -3. We don't need to overanalyze that. They are already acquired. In other words, they're going to generate cherries without a Brussels sprout, because the Brussels sprout is a sunk cost from the past, right? Meanwhile, every other cohort, including the cohort that we are just about to acquire at time 0, involve paying a Brussels sprout, right? So, well, let's assume that we're going to acquire 192 customers at time 0. That means we're going to have to pay 192 Brussels sprouts. At t=1 and t=2, we expect further growth in its customer base. It's going to grow it by 75% per year. Thereafter, it will grow its customer base for 40% per year, times 3, 4, and 5, and 6. And I'm just gonna, to make our life easier, by the way, I'm gonna assume unrealistically that the company is going to stop acquiring customers from then on. So times 7, 8, 9, whatever numbers follow that, 0 customer acquisition thereafter. Each acquired customer is going to generate $200K in revenue to the company every year in perpetuity. Believe it or not, there are plenty of enterprise SaaS customers that pay that much or more, above $1 million even, sometimes far more than that. So these are companies where like some of these, like, I mean, Dropbox, makes what they make, maybe 150 to, I don't know how much they charge me anymore. I mean, I'm that sticky. I don't even know how much they charge me. But my guess is 150 to 200. If someone tells me that they charge $999 now, I will feel a little bit dumb. But in any case, enterprise SaaS is a completely different creature. Huge sticker prices. I mean, whatever, take a look at Oracle. Look at their market value. Look at how many customers they have. Yeah, exactly. right? So in any case, so 200K per year in revenue. Let's assume servicing this customer costs 150K per year, both paid at the end of the year, just to keep our modeling simple. In addition to this cost, the company bears upfront and one-time sales and marketing costs of 260K to acquire each customer. Again, this is a simple example. I have more realistic versions of this example later on in my slides, which are covered in those additional videos that I will share with you. But for this example, to keep our analysis, relatively speaking, simple, we will assume that there are no taxes in this world, there are no CapEx in this world, and there's no working capital in this world. Again, I'm not trying to teach you that that's the right way to do it. I'm just trying to focus on the real unique aspect of this model, which is, as I said, cohort analysis focused on a cohort build of revenue and a cohort build of, I guess, EBITDA or EBITD. We will see in a second. I don't remember how I did it. Furthermore, assume the quantities described in the second paragraph above are constant over time and that the discount rate for valuing the company's cash flows equals 10%. As I said, we'll relax these assumptions later in more elaborate versions of this example. Given what I've described here, now the question is, what does your financial model look like? And what are best practices around building this model, right? So now let me go and start sharing something else, which is gonna be my spreadsheet. Let's see, boom. Can folks see my spreadsheet here? Thank you, Frank. Look, I mean, this spreadsheet may look really complex to you. I'm not gonna go through it with a fine-tooth comb. My goal here in our last 10 minutes is really just to give you a high-level overview of what's happening in this spreadsheet. And again, you know, at the end of the day, if you want to really get comfortable with this, you need to put your own time into this, right? And my hope is the additional content that I give you guys, and I will give you guys my slides, I will give you this spreadsheet. My hope is that that stuff maybe helps accelerate your path towards learning this, if you find it helpful. If not, apologies. But it needs to be self-study. If I didn't build all this stuff myself, I wouldn't know it that well, right? So, you know, whatever. I'm not sure if I've done a good job marketing the idea that this is good. Thank you, Wenhan. I don't know. Let's assume. Okay, I'll leave it at that. I'm touched. That's the nicest thing anyone has digitally indicated to me since the start of our Zoom planet. But let me walk us through this. Look, there's a bunch of numbers here. By the way, just so you know, eventually down the road, I actually build something where all of the numbers actually come from representative data of a typical SaaS company. In other words, I'm trying to build a model that's actually representative of the average SaaS company. And so it says here, blue denotes not informed by real world data. Red denotes informed by real world data. So as much as possible, I'm trying to give you guys stuff where this is not completely disconnected from reality. I think the real world is somewhat important. Yes, Ben.
Just because the customer acquisition costs kind of lead to like future benefits, would they ever try to capitalize these then?
Okay, Benjamin is asking a good question. Suggests to me that you've thought about this before. You know, in my model here, I am not capitalizing it. It's actually a really good question. The answer is most companies do not. There may be some leeway in accounting standards that might allow you to. There is a little bit, you know, look, there's like limitations to what you can capitalize, right? You can't capitalize R&D for the most part, right? For good reason.
And they're making huge assumptions about what the future cash flows look like from those customers.
That's the problem with capitalizing. So you've hit you're right, right? That's the risk, is like, you end up saying like, oh, you know, I got this customer, I'm gonna keep them for a Google years. And so actually, if I take this 260 and divide it by Google, it's like a micro penny. Do you see how that like could give you numbers that seem like outlandishly optimistic? Would you agree with
Yeah.
that?
Yeah, totally. And then even if it's a non-GAAP figure, it still
Yep,
could be crazy.
exactly. Right. By the way, there's plenty of grumblings of companies that have like huge CAC and have started, at least in their non-GAAP stuff, capitalizing the stuff with wildly optimistic assumptions to try to make their description of the world more optimistic than maybe a rational one. And so, yeah, capitalization, that's going to be something that's interesting. My guess is there's going to be scandals around that in the future. Like what I would say is if you see a company capitalizing it, you may want to like have your little radar up where you're like, do I believe the way they did it? Or do I think they're doing it to try to manipulate beliefs to the optimistic side? And if you're worried about that, you may just want to think about whether you want to buy the company anyway, because it's basically, you know, your view is maybe that actually the people preparing these numbers are jackasses. Who wants to invest in a jackass?
Yeah, and just like what rate they use to discount it all, it's a mess. So thanks.
Yeah. So by the way, it's really tough, right? So it requires like these are tougher companies to analyze precisely because of what you say, and it requires like some level of good faith. It also means like I don't want to trust what they do. I want to like do it myself, right?
Yeah.
So sometimes it's more difficult, sometimes it's easier. Like I have to admit, like, you know, when I've done it, because I do it for a client and they give me the crown jewels in terms of internal data, I'm like in a much better position to assess it than I would be as an outsider who only gets aggregated financial statements. By the way, so like, in other words, like I actually have worries that like people have a distorted view about this stuff in public markets. It's my biggest fear. My biggest fear is that the market is overly optimistic about how long you can keep customers in these recurring revenue business models.
It's funny.
I may be wrong, I may be right, but that's the thing. It's the biggest thing that I worry about. But we don't get to tackle that nut here today. Yes, Sophie.
I was just going to add on to that. So does that, okay, we see that they're kind of like doing some questionable like accounting and capitalizing, you wouldn't trust that. But like if these SaaS companies, they are expensing it, then how would you know that if it's like, okay, they're expensing it, so good, at least they're being honest about that. But like, does that mean that
I'm not going to give them that much credit for honesty because I believe the gap thing is expensive. It's too uncertain whether you're going to keep a customer a long time to allow you to expense.
Okay, so like an honest and good SaaS company should be expensing. Otherwise, it's like questionable.
Yeah. In fact, you'll see in my model, I'm expensing right away. I'm not capitalizing.
Okay, thank you.
I was just going to quickly mention like that this business model is like more similar to like a mining company's business model than it is to maybe like some of the traditional tech companies.
Yeah, that's right. With the additional
upfront capex and then the sustaining like
right, or like real estate has had a recurring revenue component to it. I have to admit, I am not that experienced with mining companies or infrastructure would be another example. Real estate, so I'm not familiar with the nuanced best practices of valuation and those things. So if anyone is, and if what I'm describing is exactly what they do, please let me know. I'm kind of curious. But I don't pretend to have domain expertise on those things. So I don't want to venture a guess, I know it's important to know what you don't know, and I don't know that shit. So, but you may be right. Look, okay, we've got 4 minutes, so I'm going to keep this brief. Again, there will be videos where it goes more at length. My real goal here is to give you guys some intuition and maybe to give you guys some buy-in on whether you think what I am talking about is important. But the key thing in my model is that I am looking at operating income by cohort. And so what's the operating income associated with the past, right? As I said, there's 256 customers in the past. What's the marginal operating income from those 256, right? Well, let's take a look at the numbers here. We made a net of 50, right? Because we received 200 from them. We have to pay 150 to service them. In other words, our per period marginal profit for the customers we've already acquired is 50. There's 256 of them. Thus, marginal profit in this period right now, times 0, and every period in the future, time 1, 2, 3, 4, yada, is going to be 12,800. And let me be clear, in my model here, one simplification is I'm assuming we keep our customers forever. There could be a churn rate where we lose customers. That's easy to incorporate here. If you lose 10% of your customers per period, this number falls by 10% per period. So far, so good? Right? Hopefully you guys will agree with me as we talk through this, that actually analyzing each cohort individually is actually not that difficult, right? Because what is our cohort at time 0, right? This was the sum of all cohorts up till time and including time -1. Then the cohort we're getting right now, we'll have to pay money to get them. How much do we pay? 260,000 times 192. We pay 49,000, well, no, sorry, 50 million. We're paying almost 50 million to get those customers. Interesting. That is a big ass Brussels sprout, right? And then what do we get? Well, next period, we're going to get 50 times 192. Then the period after that, 50 times 1. We get the point here? It's just a negative followed by a perpetuity of positives. By the way, when I say unit economics, it's literally do the NPV of this infinite stream of cash flows. If that's positive, yes, victory. If it's negative, oh fuck. All right. Yes, Mo.
Yeah, a really quick question. I'm just curious to know, because a lot of times public companies, they're not gonna, give out these numbers. What are the sort of proxies that you would use from a 10K for, say, like CAC or other kind of
Mo,
items you would use?
Question. It's a great question. I don't have time to answer it today. So maybe we can kind of collect some of these questions later on, and maybe we do a session where we do Q&A around those things. It's just with the 1 minute before Sachin comes in, I just can't answer that question, but it's a good question.
Good.
Look, the rest of the way, all I'm going to show you is, look, the next cohort, notice nothing happened. The cohort you get at time 1 gives you nothing at time 0 because it hasn't happened yet. At time 1, you'll have to pay for them, and then you'll get positive goodies forever thereafter. Do you guys get this pattern? This is the cohort at time 2, 3, 4, 5, 6, yada. Everyone okay with this? Each of these columns, notice, is super simple. If you sum up across all of the columns, you get the operating income period by period. Each column is simple. Notice how not simple the aggregate is. You are losing more and more money initially, and then you start winning money. And the long-term future looks really nice because once you're done acquiring customers, you only have cherries. And by the way, you have a lot of cherries, and you have a lot of cherries coming down for the rest of time. That's why these companies can be valuable. And that's the crux of modeling recurring revenue businesses. We can add a bunch of bells and whistles to this to make the exercise more realistic, but this is the heart of the unique aspect of financial modeling for these types of businesses. All right. I think, look, at the end of the day, this is all I wanted to talk about for today. As I said, I will share videos where we talk about refining this to cover the real world a little bit better. Actually, Mo, in my video, I think I do a quick discussion of your question, but I don't go through it in as much length as I would like to kind of better answer your question. So again, maybe we can have a session someday where we do that. But nonetheless, I hope this session was helpful to everyone. Again, I am a big believer on the importance of building proficiency around analyzing these types of companies. So I hope I've motivated you guys to want to do deeper digging into this. If not, that's okay. I won't judge. I mean, I'm not even going to monitor whether you do it or not. But yeah, I'll give you guys additional content. I hope this was helpful, and I hope everyone has a good remainder of the day.